Welcome, everyone. We're just going to give it a few minutes for people to be let in. We still have folks joining, so we'll give it just another couple of seconds here before we kick things off. All right. Well, welcome, everyone. Thank you so much for joining us here at Curi Capital for our market outlook presentation. My name is Jeff Burney. I'm the Chief Client Officer here at Curi Capital. I oversee all of our client advisory frontline-facing individuals. And I am joined today by Andy Baker. He's our Chief Investment Officer, and Andy has spent nearly 2 decades helping us shape our investment platform and now leads the firm's overall investment strategy. He oversees our investment committee and collaborates across our equity, fixed income, and private markets teams to guide portfolio positioning and long-term investment decisions. Andy brings a deep expertise across both traditional and alternative investments, and we're very excited to have him share his thoughts on the markets and the opportunities ahead. So we will have about 30 minutes of prepared remarks and time for Q&A to follow. So we're planning on about 45 minutes. We're going to be covering here on the agenda some AI commentary that is on everyone's mind, as well as the traditional economic and market update and how we are positioning clients' portfolios and advice and key facts that we have for you all. I just want to point your attention before we get things started that there at the bottom right of your screen, there is a Q&A box. You can use that for live questions. So if anything comes up as the webinar goes on, please use that to send us questions, and we'll come back and be able to answer as many of those as we can. We've got a number of those in advance, so no issues if there aren't. But without further ado, I'd love to pass things along to Andy Baker, a colleague and Chief Investment Officer here at Curi.
All right. Thanks, Jeff. Appreciate that. And thank you to everybody for joining. Really great to have everyone here today. I thought I'd start with just sharing some takeaways. So, I'm trying to make it easy for everyone. 3 key things I'm really hoping that you take from this presentation. The first is, as Jeff mentioned, there is a lot of excitement around artificial intelligence today. It reminds us of the late 90s and the tech bubble, but I think there's some important differences too. So we're going to talk about that. After that, we'll talk about the economy and the markets. We really came into the year on solid footing. This war in the Middle East is a wrench in the gears, but we do think that the journey will eventually resume. And then finally, we'll talk about how we're positioning portfolios today and get into this theme of broadening out that you'll hear me talk about over the next half hour. And the idea that the market, which has really been driven by the S&P 500 and particularly 7 stocks within it, we believe that performance is going to broaden out beyond just those AI stocks. Okay, those are your takeaways. Now let's get into a little bit, and I'll share some background of why we believe those things. And I think we need to start with the big thing in the market today. It's the 800-pound gorilla, and that's artificial intelligence. And so I'm sure many of you use AI in your personal lives, in your professional lives. Here at Curi Capital, we're finding new ways to leverage AI every day. I think we're still very much in the early innings. But for example, we're already using AI to more efficiently pull information from company filings, key information that our analysts used to have to pore over filings to extract. We can use AI to get that much more efficiently and then spend more time doing actual analysis. In the private markets, we're using AI to compare key terms of private investment opportunities that we see, pouring through legal documents, pulling out the information that we need, gives us more time to focus on analysis. From an investment perspective, again, the tech bubble is an obvious comparison. And we do see some similarities to the tech bubble with what we're going through in AI right now. So the capital expenditure cycle, right? That investment that's going into the AI build out, it has that same kind of, if you build it, they will come logic. The five largest hyperscalers are set to spend over $700 billion in AI data center CapEx in 2026. So that's an enormous amount of capital that's being deployed, but the benefits are materializing a lot more slowly. Back in February, the National Bureau of Economic Research found 90% of firms reported no impact from AI on workplace productivity. So this does remind us of the internet boom, that disconnect between all the money that was being invested and the economic benefit that was being realized. So that really leads to my first takeaway, right? That the excitement around AI reminds us of that, but there's some important differences too. And the differences, for one, Microsoft, NVIDIA, Google, these are highly profitable companies with billions of dollars in cash, making billions of dollars every quarter. These are the companies at the center of the AI boom. In the 2000s, many of the leading companies were losing money. And a lot of this investment build out that we're seeing is not being driven by debt. Companies aren't really levering up to make these investments, at least not yet. And so what we see is that translates to valuation. Back in the dot-com bubble of the late 90s, forward PE multiples, that is the price that the market was paying for the S&P 500 relative to the earnings that were expected over the next year, that number got as high as 30 times in the late 90s. Today, the S&P 500 is trading at 22 times forward earnings. So that's not cheap. The average is about 17 times. So the market's not cheap. It is expensive relative to history, but it's not in that crazy bubble territory that we saw in the late 90s. There's two key things we're watching going forward as we keep an eye on AI and look for signs of a bubble, look for signs of investment opportunity. The first is this precedent of infrastructure overbuild. So, we saw in the late 90s all of the fiber that got laid in the ground to help lay the foundation for the internet. Back 10 or 15 years ago during the shale revolution, when we discovered we had technological innovation that allowed us to extract much more oil and gas from the ground, there was a huge build out of midstream energy infrastructure, pipelines, to facilitate that. Those were both huge revolutions, and ultimately proved profitable, but there were big bust periods in the intermediate term. We don't believe that's happening today in AI, at least not yet. So our equity analysts report a backlog for cloud computing for Amazon, Google, Microsoft, $300 to $500 billion each. And that visibility keeps extending out into 2027, probably into 2028. So while there is a lot of supply, there's even more demand for this AI build out. There's also some powerful restraints in place too that's slowing supply down. Regulation is increasingly slowing down the development of new data centers due to NIMBYism, right? Not in my backyard. People don't want data centers built in their neighborhoods. That's slowing down development. Data centers are also a lot more complex. They have longer lead times than laying fiber or laying pipeline. So that's helping to keep the build out somewhat restrained. The other key thing that we're watching is productivity. So that productivity part is really important. And we think back to this phenomenon called Jevons paradox. So back in 19th century Britain, when they first invented the steam engine, it made coal much more efficient. And so, everybody thought, great, we have this steam engine, we won't have to burn as much coal. But of course, the exact opposite happened. The world burned far more coal after that because they discovered so many more things that could be done by using the steam engine. And we see that pattern repeat over and over again with technological breakthroughs leading to actually more demand, not less, even as things become more efficient. We expect we'll see that the same dynamic here with artificial intelligence as these tools collapse the cost of legal work, consulting, accounting. It's just going to expand the addressable market. So it may take time for those productivity gains to filter through the economy, but eventually users will benefit, not just the producers of AI. And we think that's long-term bullish for companies beyond these Mag 7 companies or the big AI companies. So bottom line, we recognize that artificial intelligence is a real paradigm shift. We're riding that wave. We expect there to be volatility along the way. Software stocks just got crushed back in February as the market started to fully appreciate the threat that AI posed to software. Now they've rebounded back tremendously just in the last few months. I don't know. Next quarter, maybe the market will determine that AI expectations have gotten too lofty, and it'll be some of those big AI companies that are trading down. We know volatility is part of investing, but we want to keep our eye on these long-term trends, right? The risk of overbuild and AI's impact on long-term impact on the economy and on profits. Okay, let's switch gears. Let's get into the nuts and bolts of the economy and the market. And this brings me to my second takeaway, which is that the economy and the market really came into the year on solid footing. So let's start by looking at economic growth. This is a chart of the ISM manufacturing PMI. It's an index based on surveys of purchasing executives in the manufacturing industry, and it's a highly correlated leading indicator of the overall economy. So a reading above 50 means manufacturing activity is expanding. And what we can see in this chart is that during COVID, when the world ground to a halt, the line plunges, right, well below 50. And then as the world opened back up, it shot back up to near 65. But then we steadily trickled back down. And for the last few years, that number has been hovering below 50. Well, a few months ago, back in the fall, we really started to see a rebound here. We just got the May number yesterday at 54. So really healthy manufacturing activity and actually on an increasing trend, which makes us feel pretty good about economic growth from this point. If we flip it to the labor market, the trend has been softening, but the labor market is not yet soft. So if we look at the black line, that's the unemployment rate. It's at 4.3% today. Now you can see that it's bounced off the bottom, but it's still below that 5.5% long-term average. If we look at the blue line, wage growth, that's at 3.6%, which is still above the long-term average. Looking beyond these headline numbers, we know that the overall labor force has grown by 2.1 million people over the last 2 years. The prime age labor force participation rate is near a record. That is, prime age workers in their prime are participating in the labor market at near record levels. And initial jobless claims are near cycle lows. Initial jobless claims are a good leading indicator of the direction of the labor market. And again, at cycle lows. Now, going back to AI for a minute, we've probably all are aware of the AI's potential impact on jobs, and that is a concern. We've seen some headlines of layoffs at tech companies like Meta, Microsoft, Amazon that have attributed some of those layoffs to AI. But those are anecdotes. But there is other information that causes us to be a little bit more optimistic. Software job postings have increased recently. The unemployment rate for 20 to 24-year-old workers has been decreasing since last fall. So those workers who were just entering the workforce, they were thought to be most at risk of losing their jobs to AI as AI took over entry-level tasks. But that unemployment rate for those workers has actually been decreasing for a number of months. Now, in my opinion, there will be job displacement. That would follow the historical pattern when we have big technological revolutions. Back when the automobile was invented, horse and buggy drivers were put out of work, right? This time, AI-enabled self-driving cars, that's going to be hard, and that's going to put a lot of Uber drivers out of work. There will be all kinds of things that we can't even anticipate. But again, think back to Jevons paradox and this idea that all sorts of new industries are likely to emerge that we can't even wrap our heads around yet. So there will be significant impacts to parts of the economy. But in any event, we're not even seeing these things show up in the numbers. Now, one question that I think is on a lot of people's minds is, with all the headlines that we're seeing and all of the risk that we see out there, how is it that the markets are hovering right around all-time highs And the answer to that is earnings. So the good news is that we've enjoyed 2 years of double-digit earnings growth, and analysts now expect 22% earnings growth in 2026. Just an astounding number, and double-digit earnings growth to continue into 2027 and 2028. So that is really the key reason that the markets are at all-time highs today. Now, the bad news is those are pretty lofty expectations. The average earnings growth historically is about 7%. So we're looking at 2 times, even 3 times more than that. That sets a very high bar, and could be setting us up for disappointment if we don't meet it. Now, we're just getting through first quarter earnings season, and what we've seen through the first quarter of this year is that really strong growth continues. The S&P 500 grew earnings at double digits again in the first quarter. And importantly, every sector, all 11 sectors of the market, reported revenue that exceeded initial expectations. So that broad-based strength really underscores just how resilient the economy has been through the first 3 months of the year. I don't really like the term cautiously optimistic. We kind of joke about that around here. It's sort of like jumbo shrimp, like you kind of got to pick a side. But I will say I am cautiously optimistic that this earnings trajectory is going to continue. And importantly, it's not just the Mag 7. I've referenced the Mag 7 a couple of times. Many of us probably know what that is, but it's Apple, Facebook, Google, NVIDIA, Microsoft, Amazon, and Tesla. 7 enormous companies. And those companies have been the key drivers of growth for a number of years. So the top table that you see here is recent returns for the Mag 7 and then the S&P 493. That is the other 493 companies in the S&P 500. And what we see is that the Mag 7 share of the S&P 500 returns over the last 3 years is 63%, 55%, and 46%. So those 7 companies have been making up a huge percentage of the market return. Now on the bottom chart tells us why, and that's earnings growth. So for the last 3 years, the Mag 7 earnings growth has exceeded the S&P 493 by 44%, 36%, and then 12% last year. Well, those are big numbers, but importantly, what you'll notice is that gap is narrowing. And the market is more focused on the direction. It's the direction of change that matters more than the absolute level. So these are all indicators that things were looking pretty good coming into the year, and there was really a broadening out happening in the market. But of course, we know the story doesn't end there. The war in Iran that began back in February is definitely testing our gumption. So we know that volatility is a part of investing. We all know the market goes down. Nobody knows when it's going to go down. And if you want to try to time it, you have to know when it's going to go down, and you have to know when to buy back and get the bottom just right. So very hard to do. I think you're better off just building a resilient portfolio, kind of being aware of your anxiety, sticking to your long-term plan, right? Wars make us tempted to time markets. But the situation in the Middle East really shouldn't be the thing that causes you to make major changes to your portfolio. It's changes to your personal situation that should cause you to make major changes to your portfolio, right? You're saving to put your kids to college, or getting ready for retirement, or purchasing a new home. These are the things that cause us to make big portfolio shifts. Our investment teams are making little subtle shifts as a result of what's happening in the Middle East. Now, this picture here is, of course, a picture of the Strait of Hormuz. It's 21 miles wide at its narrowest point, and 20% of global oil, as well as a lot of other commodities and goods, flow through the Strait of Hormuz. Now, we know the world relies on cheap oil, and it's really been something of a one-factor market since the war began. So back at the end of February, oil was at around $72. Towards the end of March, it peaked at $120. Today, last time I looked, we're at around 95 or 96. And equity markets have really been trading inversely with the price of oil for the last few months. Oil goes up, the equity markets go down. We get some good news that comes out. Oil goes down, equity markets go up. I'm sure we've all been watching this. We've all been paying a lot of attention, following the twists and turns, and really hoping for some resolution. Now, I can't predict the outcome of geopolitical events better than anybody else. But I'll tell you what my base case is, and that is my base case is that there's not too much more pain from here as a result of the conflict in the Middle East. And there's really two reasons for that. One is historical precedent. So what we see is after a temporary drawdown, markets tend to look past geopolitical conflicts, and maybe we've already seen this play out. So the S&P 500 was down 9% at the start of the war. But since that time, we're up 20%, and we're back to right around all-time highs. So was that the drawdown from this conflict? I don't know. It's possible that we'll get a deeper drawdown again in the future. But it is quite possible that we've already seen that rebound. The second thing is just kind of bringing it back to the basics and thinking about the situation on what really drives equity markets, which is profits and valuation. So from a profits perspective, the U.S. economy is not just driven by oil prices. The market has been very much driven by oil prices recently, but the economy and corporate fundamentals are much less. The relationship between the price of oil and the market has weakened a lot since previous oil shocks. The U.S. reached energy independence back in 2019 as a result of the shale revolution, which we mentioned earlier. We're now a net exporter of oil. So from a fundamental perspective, we are less sensitive to higher oil prices than we have been historically. From a valuation perspective, one of the primary drivers of valuation is interest rates, and one of the primary drivers of interest rates is the expectation for inflation. And so this chart shows a market measure of future inflation. So, not the inflation that we've experienced so far, backward looking, but what does the market anticipate inflation is going to be in the future? The dark blue line is the market's expectation for what inflation will be over the next 12 months. What we can see is that it was about 2.5% before the war began. It got up as high as 3.5%, but now we're back down to about 3%. So that tells me that inflation, at least so far, the expectations are mostly being held in check. In fact, it's increased, but really just back to where we were last summer. Now, again, this is not the inflation that we've experienced. We have experienced higher inflation. The inflation numbers that we're seeing are coming in are higher. We know that the price of gas went from $3 before the war began to $4.50 today. That's a big increase. But the market is forward-looking. The market is pricing securities based off expectations of the future. And if we look at that light blue line, that's what the market is expecting inflation to be over the next 5 years. It started at 2.4%. We're now up to 2.7%, so it has increased a little bit, but it's not a big structural problem, at least not yet. We can look back a few years ago when we did have a big problem with inflation back in 2022, and the expectation over 5 years was that we would get to 3.7%. Again, we're only at 2.7% today. So as we're sitting here today, the expectation is that inflation is largely held in check. Now, it is always possible that things get worse. Every day the conflict drags on. Every day the Strait of Hormuz, every day it's closed. The problems with oil supply and other commodities, other goods, that magnifies. And so if this drags on a lot longer and the market starts to change its mind, then the playbook shifts and other things are attractive. What is that? Energy producers, chemical companies, commodity-linked assets, physical infrastructure. And I'll tell you, I think these were already attractive even before the conflict, right? On the back of secular trends that we see, like deglobalization, shrinking of supply chains. Not to mention that these companies were cheaper than many of the big AI companies and the big tech companies. So all part of a good diversified portfolio. And these are places where we're finding opportunity today. Okay, we can start to wrap up. Let's get to some conclusions. And we'll start with some of the key risks that we see in the market. So first, what we just talked about, right? Inflation looks to be being held in check, but that could change, right? Inflation really could take hold. Expectations could get away from us. That would likely lead to a rise in intermediate term interest rates. That would be bad for the stock market. That would be bad for the bond market. Now, our fixed income team actively manages our bond portfolios. They're positioning us to minimize that risk as best as they can, but it is a risk to both the bond market and the stock market. We talked about the labor market and how the labor market has been softening, but is hanging in there. It's been resilient. That could change too. It might be as a result of persistently higher oil prices, slowing down the economy. That could have a compounding effect if the labor market starts to turn over. That could lead to a recession, which of course would be negative for the equity market. We talked about the AI build out and how there's enormous supply, but there's also enormous demand. If anything, there's still more demand than supply. But we also talked about the historical precedent that we've seen in the past, that infrastructure build out gets ahead of itself. If that happens here this time again, that could lead to a bust cycle in capital expenditures that could diffuse into the real economy. That would certainly be a risk. Of course, we've had geopolitical tension. We're facing that right now, and it seems like we're in fragile territory. If geopolitical risk increases from here, we could see a rise in risk premia across all risk assets. And then finally, this concept of a black swan. That's what frequently ends up taking markets down, is things that in hindsight seem obvious, but leading up to it, no one was really anticipating. We just see with the benefit of time. Those are always a risk. So with these risks in mind, let's get to that third takeaway. What are we doing about it? And again, you've heard me say a few times, it's this concept of broadening out. So the S&P 500, the Mag 7 particularly, they've really dominated performance for the last 5 to 10 years. I've got 5 years listed in this table. And you can see the S&P 500 was the best performing market in town. It really probably goes back more like 10 or even 12 or 15 years. But last fall, things changed. Other markets started outperforming after all those years of S&P 500 dominance. That was because of the reasons we talked about, right? A stable economy, different stimulus, strong earnings broadening out and catching up with those big Mag 7 names. The Middle East conflict has been a setback. The last few months, we've seen things kind of revert, and the S&P 500, again, being one of the top performers. But we're going to get through this conflict, and we think that trend will reemerge. And the places that really benefit from AI are going to be important parts of client portfolios. Not to mention that those are cheaper, have lower valuations coming into this. So I'm talking about smaller cap companies, international stocks, more value-oriented stocks. We have a team of industry experts here that covers the whole market, not just tech. We see lots of opportunities to really broaden out. All right. The second way we're positioning portfolios today is really not stretching for yield. So what do I mean by that? This chart shows the difference in yield between the high yield bond market or junk bonds and the yield you can earn on a safe treasury bond. And what you see is that right now that difference, that spread between high yield bonds and treasury bond yields is right near all-time lows. So what that tells me is that risk reward in credit is asymmetric, and it's really not in your favor. You're taking all of that credit risk, but you're really not getting paid for it. It's limited upside. So we didn't spend a lot of time talking about credit today. We didn't really spend any time talking about credit today. We do have a number of credit strategies that we offer. We're still finding some things to do in certain pockets, but there will be a time in the future where I'm back talking about the big opportunity in credit. But that's not today, and we're really suggesting that generally now is not a good time to stretch for yield. Okay, The third way that we're positioning portfolios is similar to this concept of broadening out, but it's really considering diversification beyond stocks and bonds. So this chart shows on the vertical axis potential return, and on the horizontal axis potential risk as measured by volatility. And what you can see is that by adding 10% of your 10% of your portfolio into alternatives, alternative investments, you have the potential to shift your portfolio up and to the left. That is, increase the return potential and decrease the risk. So what do I mean by alternatives? I'm talking about things like private equity, venture capital, real estate, infrastructure. And many of the themes that we've talked about today, AI, data centers, energy, these are exactly the things that our alternative investment team has been focused on recently. And the market is evolving. So we're now able to offer new solutions tailored to a lot of the different types of clients that we work with. Things that are focused on, some of them are focused on diversification, some on income, some on targeting higher returns. This has historically been a challenging market to access, but the market has evolved and the criteria has changed. So we're now able to provide more solutions to a broader set of the clients we work with. Okay, let's wrap it up. We'll go back to our 3 key takeaways. Again, this excitement around AI, it is really exciting. We're finding lots of ways to leverage it. It does have some similarities to the tech bubble, but there are some important differences too. We don't think we're in a bubble in AI, at least not yet. Second, the economy, the markets, we came in on pretty solid footing. The war in the Middle East has changed the trajectory, but we do think that we will eventually get through this, and we expect the trajectory to revert back to that solid footing and the broadening out that we saw earlier in the year. And again, positioning portfolios to take advantage of that broadening out beyond the significant concentration of the S&P 500 and those Mag 7 companies that were really the big drivers of performance for many years. We think that is going to broaden out to other parts of the market. So with that, I'm going to wrap up. Jeff, I'll ask you to come back on and see if we have any questions.
Very good. Thank you, Andy. We sure do. And again, a reminder to all of you that are with us, there's a Q&A box at the bottom right of your screen. So if there's any additional questions you'd like to submit, please do so as we go through. So there were a few questions in advance around some planning topics. So I thought I'd start there, give Andy a quick break. So one of those was around required minimum distributions. Specifically, is there too much money at age 55 within a 401k? Is that impacted by being married or filing singly? And again, required minimum distributions and taxes. So it's a mouthful. I'll try to break this down and give a real life example. But the question of how much is too much, I'd reframe that to say, will the future required minimum distributions, so this is what the government requires individuals to take out of their pre-tax retirement plans. If those required minimum distributions force me into a higher tax bracket than I'm paying today. So just to put a little bit more of a context there, if you were 55 today, as the question had asked, and let's just say you have $4 million in a traditional 401k, so you're putting in pre-tax dollars, it has the ability to then grow. We're assuming 7% annual growth rate. And there's no withdrawals for the next 20 years. And not only are there no withdrawals, but there's no taxes paid. So if you fast forward those 20 years at that rate of return with no distributions, that account now is worth about $15 million. And if you do the required minimum distribution calculation, that's something like $550,000 a year that the government is forcing you or requiring you to be taking out of that account, which is going to force you to pay taxes. So depending on your individual needs, that may be an appropriate amount, depending on your spending. But if it is in excess of what you're planning to spend or give away charitably, then there's a gap there where incurring you're incurring taxes in excess of what you need to do in order to meet your living requirements. So the implications for that is it can put you into a higher tax bracket, so forcing higher taxes. It can be increase of taxation on your Social Security. You may have more in Medicare surcharges, and other implications. The good news is, one of the many reasons to be married and stay married and hopefully happily, is that widens that tax bracket there. And so there are, implications there to being married versus filing as an individual. And what to do about that. So one, if you're at 55 now and looking at that is starting to plan for what would those likely required minimum distributions appear to be. Is that meeting your needs, or is there some planning opportunities that you should do? So over that next 10 to 20 year time frame, there's plenty of time to do Roth conversions. So taking those taxes up front, paying those, and then having them continue to grow, and then distributions be tax free. There's some tax bracket management. You can be thinking about charitable planning, and delaying Social Security. So there's a lot of things to do there. All of it is, like everything we do, very specific to your individual needs. The second question here is related, but what happens when you turn 73 and start to distribute money? And so again, focusing on retirement accounts here. So it depends on when you were born, if that number is 73 or 75 years of age. So if you were born between 1951 and 1959, at the age of 73, you would start taking those required minimum distributions. Typically, they're 4 to 6% of that overall account. So just there's an actual calculation for it, but just to give a sense for it. If you were born after 1960, it would be age 75. So there's a couple of additional years that they've granted for individuals to let those dollars continue to be invested and not have to take those distributions. At the time that you turn that, you have the option to take that distribution in the year that you turn that age, or by April 1st of when you'd have to file for taxes. The issue with delaying those extra 3 months or so into the next year is that you would have to take 2 distributions in that year, which again may impact your tax brackets and subject you to additional taxes that you wouldn't otherwise have to pay. So all of it is really interesting stuff. That's what we love to do. It's all very specific to individuals. So I again ask you to reach out to your advisor and have that discussion. And those are the types of topics that we're well versed in and love helping people with. Okay. So Andy, I'm going to throw one of our live questions out to you. We had a few questions that were on inflation. So I know that we covered that on page 11, and that was really focused around market expectations for inflation. So putting you and Curi on the spot here, what is your expectation? And I'll give you a multiple choice, higher or lower than what the markets are anticipating.
I'll probably take the upside. I'll take the over on what the market is anticipating. The market is smart, and it's comprised of thousands, millions of votes from informed people. I'll take the over on it. I think until I see the Strait of Hormuz reopened and oil flowing more freely, I'll kind of need to see it to believe it. But I also, again, going back to this idea of historical precedent, pattern recognition, nobody wants the strait closed. Nobody wants inflation, and people have a way of coming up with solutions that we can't anticipate. So even though we can't see a solution right now, I do think that we're going to get through this without things really becoming unhinged.
Okay. Thank you for that. Okay. So one of the other questions here is, in today's news cycle where we're just subjected to the daily change in the, minute by minute, how do you, manage or suggest people manage money through markets where it seems to be ever dependent on the next news story.
Yeah. Yeah. I mean, I guess we've talked about that a little bit with how the market is traded just with the conflict in Iran, the closure of the Strait of Hormuz, and the market basically trading with news around oil. I think it's a good example. You wouldn't think the market would be at all-time highs if all you were doing is reading the headlines and all the things that have been happening. You wouldn't think that. So it's important to really maintain a long-term focus, and remember that eventually we revert back to things like fundamentals, like earnings and just how strong earnings are right now. I think it's a full-time job to really stay on top of all of this. And that's why you hire professionals to help you, right? That's why you hire us. There's a joke, about the best thing you can do is open your statement once a year. Because a lot of the times the best thing you can do is nothing, right? It's easier said than done, but you really need to be able to kind of look past some of these headlines and focus on the long term, focus on the real fundamental drivers of earnings, the economy, the bond market.
Very good. And I'd be remiss if I didn't say, this is why you and if you've got prospective clients that are considering hiring a professional firm to help them manage their assets and their financial plan, this is one of the big reasons. So for us, it's being that steady hand for you, building that long-term plan, having the right diversification, and being able to talk through these things and also evaluate it. So Andy and his team on the investment management side are doing nothing but contemplating the markets and absorbing all that information and making decisions based on that. So it shouldn't be done alone. It shouldn't be done without a professional. And then another question for you, Andy, on the investment side. So for emerging markets, they've been a top performer this year. Are there, reasons geopolitically that there's reason for that to continue? Again, going back to that news cycle and looking at it from that perspective, it seems hard to believe that it's performing as well as it is.
Yeah, I mean, I think geopolitical change is definitely afoot. Deglobalization, shrinking supply chains, that is a secular trend that we see. Maybe that's something we'll spend more time talking about in the future. China is a big part of emerging markets. It's 25 to 30% of emerging markets. I think it peaked back in 2020 though at 40 to 45%. So China's been going through this multi-year bear market, based on regulatory crackdowns on tech, the property sector, foreign capital leaving. So what that's meant is that there's been other markets like India and Taiwan that have really rallied and have diluted China's weight. So that's I think that sort of broadening out has really been responsible for a lot of the outperformance that we've seen. We've talked about bubbles here. Korea may be in a bubble right now. The Korean market is up something like 150% this year. Emerging markets overall came into the year pretty cheap. They're up 26% as a group year to date. So like you said, a great driver of performance. So they're not as cheap as they were coming into the year, but they're still pretty cheap relative to the United States. And I think still an important part of that broadening out theme that we've been talking about.
Thank you. So I've got one final question for us, and this has to do back to your first topic around AI and an exciting week ahead for us. So not only do we have the start of the World Cup, we've also got the highly anticipated IPO of SpaceX. So that's one of three, two of which we know is planned to happen. So we've got SpaceX that's going to be IPOing next week on Friday, June 12th, at an anticipated valuation of $2 trillion. Just yesterday, we had the creator of Claude, Anthropic, anticipate saying the same thing, that they're going to be planning to go public this fall, and somewhere around $1 trillion valuation. And then we're, still waiting on the makers of ChatGPT, OpenAI, to announce the same, and it's similar in valuation and size. So that's something like $4 trillion that's going to be moving from the private markets to the public markets. To help put that a little bit into context for everyone, right now today, excluding those, there are $14 trillion companies that are publicly traded. So a pretty significant increase there. And these are companies that have been created pretty recently. And so the question really is, one, are the financial markets healthy and able to absorb this, or is this, buying into some hype? And secondly, why should all of, us care? So as investors and clients, of these companies that are going to be, soon to be, publicly traded.
Yeah, there's a lot there. We could probably do a whole a whole webinar just on that. Well, it's going to be a test to see if the markets are healthy enough to absorb these. Assuming these three companies come out this year at the proposed valuations, there'll be three of the four largest IPOs ever, with Saudi Aramco a few years ago being the fourth. And I won't get this number exactly right, but those three companies, those three IPOs combined are on the order of magnitude equivalent to every other IPO that's ever happened in the United States. So that just kind of puts in perspective just how big we're talking about. SpaceX is the one that has filed a public S1 and the one that we have the most insight into. It's a really exciting business, right? Really three businesses between space, connectivity, and AI. So a ton of growth potential and a ton of deserved excitement, I think. There's a lot of questions around it. For example, governance is going to come out with dual share class structure that will give Elon Musk full control. And so, you're basically signing up to let him do whatever he wants to do with the company. Now, he's created a lot of value and a lot of people have lost money betting against Elon, but that is not what would traditionally be considered good corporate governance. It's also, you said it's coming out at, I think 2 trillion, 1.75 trillion, somewhere in that neighborhood. That would be about 100 times sales. So if we said the S&P 500 is trading at 22 times earnings, SpaceX is coming out at 100 times revenue. So extraordinary valuation. Anthropic just filed their confidential S1 yesterday, so we'll learn more about that. We expect OpenAI to come out later this year. We'll learn more about that. But these are going to be huge liquidity events. There are lots of investors in the private markets that have owned these for a long time. They've made a lot of money, and they'll be looking to sell as their restrictions come off. And the ownership gets passed from the private markets to the public market, from the private markets to the public markets. At the same time, the index providers like S&P, MSCI, Russell, they're considering changing their rules. They have, the index providers on which index funds like ETFs are managed have rules around what they include in their indices. They're not, we call them passive investments, but there are people who actually make rules and determine what goes into these indexes. And they're considering changing the rules around how long a company has to be public or how long it has to be profitable to include it, so they can include these three huge companies in it. So what you'll see is potentially a lot of index funds buying those companies at huge valuations, regardless of the valuation or their outlook on governance, because it's in the index and they have to buy it. So many ETF investors will own significant parts of these companies. You're going to have a lot of insiders selling. I don't know how that's all going to shake out in terms of price performance, in the near term, but it is definitely going to be a complex situation. Our team, our equity team, has already, are on top of this. We've actually just put out a note a couple of days ago on SpaceX that you can ask your advisor for if you haven't already seen it. So we'll be monitoring these closely. we don't generally participate in IPOs, partly, for some of the things that I just talked about, with just the magnitude of what's happening in this transition of ownership. I think potential for a lot of volatility. One more thing I might just raise is it's kind of a reminder of how much value creation is really happening in the private markets today. So, historically, companies would IPO at a couple $1 billion, and then there'd be tons of value creation happening in the public markets, right? But now these companies are coming out at the size that something like almost the same size as a Google or an Amazon is today after being public for decades. So all of that benefit is accruing to people who were investors early in the private markets. And it's just a reminder of how that dynamic has shifted. And, example of opportunity that you can see in the private markets to invest in the next open AI or Anthropic or SpaceX, or, whatever that may end up being.
Very well said. All right. Well, I'm going to wrap things up for us here. Thank you all for joining us. If there's additional questions or things specifically or needing for clarification, please do reach out to your advisor and we can be sure to get back to you. But we deeply appreciate your time and spending it with us, and certainly your trust and confidence as Curi Capital as your financial advisor. So with that, Andy, thank you. And thank you everyone else. Look forward to seeing you all soon.
Thank you.